Okay, hello everyone. This video is titled "Why I Think Mining Stocks Are a No-Brainer." I call it video one in case I do more videos on it. I think there's many more reasons than what I'm listing that mining stocks are a no-brainer. So there could be other videos, and I'll explain later why I'm comparing 2008 versus 2021. And by this date, I mean present. Presently, the day that this data is taken, by the way, is March 1st, 2021. The purpose of this video is to show that the risk reward profile in mining stocks in 2021 is over 20 times better than it was in 2008. And here is the one that I keep hearing from other people that are afraid of this so called deflationary move. They know that something like this, they sense something like this might be coming. And one of the purposes of the video is to show why this is not like this big of a move is not likely to ever happen. Uh, not it's we're nowhere near uh, getting to this type of move. I mean, we have to be off the charts in order for something like this to happen. There's just no room for it to happen. Here's our relative low. I'll get into that. And what I'm looking at, I'm using the Huey index as a proxy for mining stocks. And it's a pretty good proxy. I have many of the individual miners from this index. There are other indexes as well. I think there's a Philadelphia Gold Index. The reason I like this one is because it says BUGS, and if you don't already know, that stands for Basket of Unhedged Gold Stocks. And I like the idea of unhedged. So I started, I certainly have more different mining stocks that are in this index, but this is the one I always go to because this is where I started searching for mining stocks to buy. Okay, what this really is uh, not all of the downward moves are like this, but when there is a financial crisis which causes a sharp spike up correction in the value of the dollar, which it does from time to time. Mostly the dollar, as everybody knows, is just going down, down, down. It's lost, I don't know, over a long period of time, it's lost 98, 99% of its value. Um, and so most everyone knows about that. But when it drops too fast, or sometimes there needs to be a correction, and the value of the dollar actually spikes up. And then what that does is when the dollar spikes up, everything priced in the dollar spikes down temporarily, and that should be viewed as a buying opportunity because we know it's temporary, and it's something it's going to resume. The dollar is eventually going to resume its downward trend. So it'd be nice to be in cash. I will admit this. It'd be nice to be able to call that exactly and be in cash during that time. But I don't know anybody that can do that. This move down in the Huey from 515 to 169, which is what the value was up there, 515 to 169. That's a 67% drop. And here is another. These are the only deflationary moves that I could find, and of course, we're all familiar with the what happened in the markets in March 2020. There was that big drop right there, and that was a 31% drop. And those are the only deflate. The other moves, which there's not that many that are bigger than that, but there's a lot that are like that. Similar to that move right there. And let's just look at a few of them. Some of the other drops in the Huey that were not deflationary drops, just regular moves in the Huey, up and down, up and down. Some of them pretty big. And I will mention one other thing, that this kind of highlights the importance of having a log scale to be able to toggle on and off. And I can't really do it with this, but you can see, you might be looking at that and say, well, hey, that's 58%. How can that be 28%? Because the red line's that's a bigger drop. Well, no, it's not percentage wise. Percentage wise, this is something like going from 90 to 30 or something like that. And this is going from, approximately 350 to 250. And that's, that's about a 28% drop. That's the exact drop. So the lower it is on the scale, the bigger the percentage drop. And this reflects what would happen to your account. These kind of, the percentage is what we're interested in. Is what, percentage up and percentage down is what affects our accounts. That's why, and I'm going to get off track just a little here. That's why when the stock market's at 30,000, in order for you to triple your money, and I'm talking about the Dow Jones Industrial Index just as an example, in order for you to triple your money, it has to go to 90,000. Now, how realistic is that? And yet, already in this move, I've got mining stocks that are up 500%. Even right here, even after this drop right here, I've got mining stocks that are up 500%. At least it was yesterday. I don't know if it was today. It was just barely over, but approximately 500%, some of them. And so now we're getting into what I want to compare is this point versus that point. And because this point it seems to be what a large percentage of people are fearing will happen right here. So you can see me toggling back and forth, and I'm amusing myself just like John Madden does when he has the controls for the replay. But anyway, so that's what we're comparing. That, which is what everybody's afraid of, and that where it is now. And just to go back to this, notice the Huey's 515, and yet gold's only 968. And then over here, the reverse is true. So to be worried about a deflationary spike in the dollar and a drop, which could happen, but there's just not enough room, as I'm going to show. Well, actually, I'm going to show the risk-reward profile of these 2 points right here. Okay, now I always have to go back to that. That's my base case. And this drop right here corresponds to this right here. So that's 310. It was way down in its move in the Dow Gold ratio. I've got 13 videos on this. I can't go over it here. I would just be repeating myself. But when this is going down, at any point, theoretically, it's going to be a great time to be in gold or gold mining. And when it's going up, it's better to be in stocks. Okay, so there's that point. And then here is the present day. And so we've just barely, in fact, we've only moved 1/5 of the way down to our projected point of 0.62. So this, we started at 22.36, we went down to 0.62. And, you know, again, that's on those 13 videos on the Dow gold ratio. You could Google my name and Dow and then gold, you know, John Campbell Dow gold. If you don't put the Dow and the word Dow and the word gold in there, then it's a real common name, and you'll get all kinds of different people because there's so many John Campbells. Okay, so again, here I just put this on a spreadsheet to show the ratio of Huey 310. On 310 it was 0.53, and here it was 0.54. I mean 0.14. So that is a big difference between now and then. Okay, now if all we do is extrapolate, I mean it normalize this number to this number, then the Huey goes to 925 and gold goes to that number right there. That's just a different way of calculating something I've calculated before. I think I came up, it's a real good correlation too. 62.95 is the number I came up with uh, over a year ago, and I've always stuck with that number. So this number is right in that ballpark. And there I'm just circling what we're focusing in on right here is this first one. Okay, so let's look at that visually. There's the numbers visually. And we know what happened because this is in the past. From that point, we had that much reward and we had this much risk. Now, it didn't drop that far, it dropped only to there. But here's my definition of reward and risk. Well, it's specifically the risk side. We look back at least 10 years and find the lowest low. So that's what the risk is. We're at risk of dropping to there, even though we didn't. So that's the way it looked in 2008. So as you can see, much smaller reward for much higher risk at that specific point. So here it is. That's just the calculation. Those are the actual delta risk and reward, and then I divided those two, as I'll show you in a second. Don't worry about the numbers. I'll show you in a second. I'm going to do this also for 2021, and you'll see that the risk reward ratio is fractional compared to that. So that's 4.65. You don't have to remember any of these. And recall that all I'm saying here is that I projected to 925, and that's a really conservative number. It could go a lot higher than that, I know, but let's look at it graphically. So here we are at this point, present day, 250 on the Huey. And if we look back 10 years, which from 2021 would be 2011, here's the low point right here. It's Huey 107. So there's the risk. We already know that. And we have no choice but to project out into the future what the reward is. And like I said, I've said that's conservative. So you can see it's just monumentally different. There's our reward in green and our risk in red. And so numerically, that fraction is 0.21. And here's the conclusion is 2021, as far as risk to reward is concerned, it's just simply that number divided by that number and put in a percentage format, and it's 21 2,195% better risk reward ratio than it was in 2008, and that goes back to the what I was saying right at the beginning. Uh, uh, let's go back and look at it, and that'll be it. Uh, it's over 20 times better than it was in 2008. Mining stock, the risk reward profile in 2021 is over 20 times better than it was in 2008. I'll finish up there. Thanks for watching, and good luck trading or investing, whatever it is you're doing.